All right, guys, welcome to class 7. So you made it through an epic class 6, part 1, part 2, and part 3. And now we're going to dive in here to class 7. So what we're going to do today is talk about a specific type of reversal trading strategy, which is the rubber band strategies. Okay, so tomorrow, or in class 8, chapter 8, we will be talking about parabolic stocks. And the stocks, basically, when I say parabolic, are the ones that go from $2 to $4 to $8. Now, I have a chapter specifically dedicated to those types of stocks because we see them on such a regular basis, and you do trade them a little differently from a stock just kind of making a 5, 10, 15% move. So in that chapter, I will talk about both long and short strategies for how you trade parabolic stocks. And some of those will be rubber band strategies, but there are some others as well. So today, I want to introduce you to rubber band reversal strategies, and the way that I trade these typically on a regular basis will be applied to higher priced stocks. All right, so let's see. Let's jump in here. I'm just going to actually um, change one thing. Um, I'm starting at the very end of the web, or the end of the class. So let me go back up. Where am I? Lost my place here. Okay. There we go. So we'll do the FAQ section, of course, after the class. So we'll jump into that in a second. But first, we'll start with the class. So what you'll learn today is how to use short selling and reversal strategies to capitalize on the imbalances that we see between buyers and sellers that get stocks really, really extended to the upside. Now, obviously, if stocks are really extended to the upside, there's the inevitable move that they will have back down towards, sort of equilibrium. It's just going to take time. And so a stock can continue to be irrationally strong for hours and hours and hours, sometimes even days or weeks. But at some point, we will see a reversal and it will come back down. So this strategy is about showing you how to capitalize on those imbalances when a stock is really extended and is bound to come back. These are good for both midday or afternoon trades. And they're actually, this is the one strategy that I wouldn't trade in the first 30 minutes that much. I would really focus this strategy more from 10 a.m. until about 3 p.m. So it's a good strategy for midday trading, afternoon trading, late morning trading, and it's a great strategy for a trader who prefers a slower moving approach. Obviously, the momentum strategies that we were reviewing in Chapter 6 are very fast moving. Those are stocks that are squeezing up, 10, 15, 20% in a matter of minutes. Whereas this reversal strategy is looking for stocks that have been extended for a while, and rather than trying to jump on that momentum, we're just going to watch them continuing to run and wait for that reversal point. And then we take our position, either to get short off the top or to buy right off the bottom. So that makes these trades typically slower. They take more time to form because you have to sit patiently and watch the stock get extended, sometimes for hours before you get a good reversal opportunity. And then by the time you get that reversal, often, you're not looking for just a momentary pullback. You're thinking, if this is truly the reversal, we could now just trend lower for a period of hours. So you could potentially hold these positions for much longer. So this is a strategy that's great for someone that wants to trade, to take a little bit more time, be a little more methodical, and potentially to trade with smaller share size. Someone who doesn't feel comfortable taking 3 or 4,000 shares of a momentum stock might feel better taking 300 shares of a $50 reversal and holding it for a longer period of time. Now, I personally have always made more money on momentum. So reversals have never really been my bread and butter. They've never been the strategy that I make a lot of money on, but it's a strategy that I've kind of, I guess, fallen back on during times when momentum was a little choppy, or when I just sort of wanted to trade with a little bit less stress, because it is a little bit more laid back in terms of the speed and that sort of thing. So this is important for all traders to understand reversal strategies, because number one, even if you're a momentum trader, like I am, by understanding the reversal strategies, you understand where someone who might want to take the opposite side of your trade would see an obvious entry, right? So if you're long and there's an obvious short setup forming, it's good to see that, because that's an indicator that you should get out of the long position before all those shorts pile in. And we can see these sort of setting up and getting the right candlestick formation for a short. So if you see that in your long, that's something to be aware of. So that's why I really encourage you to know how to trade the reversal strategy, even if you don't plan to utilize it on a day-to-day basis to generate profits. You can at least look at a stock and say, this is a reversal and I shouldn't be long. Like Rob's saying, being able to sense what your opponent is doing and what their strategy might be looking for will help give you that edge. So it really is being able to predict crowd mentality, at least to a certain extent. So this right here is a reversal example. This is a stock. It was a $22 stock that gapped down. So this was gapping down. It opened around 22.20 and sold off to $21. So it dropped a point. Now, we've seen stocks just yesterday, and we'll see more tomorrow, that have squeezed up 2, 3, 4, 5 points and are like $3. So when a $21, $22 stock drops a point, it's kind of like, that's not a very big move. But at the same time, this little doji candle at the bottom, what does that signify? Remember in class 4, we talked about candlestick formations. A doji is a candle of indecision, all right? So when you see that candle at the very bottom of 2, 4, 6, 7 red candle sell-off, we weren't indecisive here. We were strongly to the sell side. A little indecisive on this candle, but then we continued lower, and now this one is a doji and it's green, where it's kind of hammering out the base because it does have that bottoming tail, but then because it's the doji, it's indecision. And when you see indecision in the context of a trend, it can indicate the trend is getting ready to shift. Now, the very simple way to trade these is to buy the first candle to make the new high. But by looking at this candle and recognizing that as this candle is forming, it's a doji, it's a candle of indecision, that will make us that much more confident to buy this green candle as it breaks the high of this doji. So that right there would have been the entry, and you can see how this went from $21.23 up to $22. So although you may not have felt comfortable taking 5 or 10,000 shares of a stock like this, I know I wouldn't. If you took 400 shares, 800 shares, 1,000, you could probably make $400 or $500. I mean, you could still have a totally decent win, and the risk is pretty minimal. So if you were going to take this trade, what do you think would be the logical stop? Low of day. Logical stop would be the low of this candle. So relatively speaking, that's a very tight stop. Versus your profit target, which is usually a bounce back up to your moving average. This is kind of the first profit target. And I'm going to show you the details of all this, but I'm just kind of giving you broad brushstrokes. This is what a reversal looks like, and this is a rubber band reversal. Now, why do we use the term rubber band reversal? And I've got my props here today. When the stock gets really, really extended, like this, it needs to snap back. It's going to snap back eventually. It's a matter of time. So the more extended it gets, the better the snap. Now, stocks that are just kind of like this, nothing happens. You want to see that extension. So remember how we talked about trading extremes. This is an extreme. This is a stock that just had, 1, 2, 3, 4, 5, 6, 7 red candles in a row, and then we got that snap back up to 22. So that's the type of thing that we're looking for when we trade the rubber band snapback. This is a strategy you can use both for buying off the bottom, long, if you don't want to short, or you're trading in a retirement account and you can't short, that's fine. You can buy the long side, just buy the bounces, you don't short them, or stocks that are really extended to the upside, you can short. Now, tomorrow when we talk about, or in Class 8 when we talk about the parabolic stocks, obviously we're going to be looking at some of the most extreme examples of potential rubber band snapbacks. But also keep in mind that those are stocks that, every time they're stretching out, they could be running another 5, 10, 15, 20 points, or DRYS that went from $2 all the way to 100. So you don't want to short too early when it's still stretching out. That's the risk. You've got to really make sure you time your entry properly. So although you can trade this rubber band snapback on parabolic stocks, the lower stress type of stock to trade it on would be stocks above $20 that are, kind of like had this sort of setup. They're down, whatever, 5, 10%, 7 candles in a row, first candle to make a new high. This isn't, the stock that every trader is looking at. It doesn't have as high of relative volume, but the chart setup is strong. Okay, so the advantages of reversals. Well, the first advantage is that it's difficult to anticipate when stocks are going to make big moves, right? I've shown you lots of examples of stocks that went from $2 to $8, but it can be really hard to get in before stocks make those moves. On the other hand, it's pretty easy to see when they're making the move because we can see them on our high of day scanners. So that gives us the ability, especially for beginner traders, to wait for these stocks to start to squeeze. And then instead of trying to jump on the momentum, before it leaves the station, you say, I just will take the other side of this trade. Unfortunately, for the most part, the strongest momentum is momentum to the upside. So when, we talk about missing the opportunity and then deciding to take the opposite side, you would be talking about shorting. Shorting stocks under $10 that have really strong momentum is difficult because it's hard to find shares available to borrow. And then, secondly, those stocks can be just extremely strong, which means they're not always as predictable. They just continue to run beyond what you would think is logical. All right. So, but generally speaking, the advantage of reversals is that it's easy to see stocks that are moving up and then sit and patiently wait for the trend to shift. So instead of trying to predict the next mover or jump in it before it makes the move or before it's gone too far, you can watch the stocks getting more and more extended and then wait for your entry. All right. So in order to trade reversals, you must be able to identify them in real time and understand your risk-reward ratio. So remember, what goes up must come down at some point. Now, it doesn't mean if you short here that you should hold and hold and hold, because they can go up, more than you might ever expect. You still have to get out of the trade if it goes against you, but eventually, even the strongest stocks make short-term corrections. And that's what this is right here. This is a short-term correction. The stock squeezed up 1, 2, 3, 4, 5, 6, 8, 10, 11 candles in a row. So this is almost like, when you have 11 green candles in a row, the odds that the next one will be red just keep going up and up and up. I mean, how many candles in a row do you think have ever in the history of stocks been green? I mean, I don't know, maybe like 40 or 50. At a certain point, it's just like you have to have a red candle. It can't continue to be green. And so that's what you kind of wait for. Whether you're trading the bottom bounce or the top reversal, you're waiting for that first candle to change directions. So I'll show you the techniques that I use to establish these entries. And sometimes I will get in early in anticipation, thinking that this candle is going to be the one that goes red and changes directions. Now, obviously, anticipating a reversal, can be a little risky because you're literally trading against the trend. The trend is going up, and you're going to try to trade against it. That's swimming against the current. That's difficult. But if you're swimming against the tide, the moment before the tide changes, then maybe you have a little bit of a head start. So that's kind of the approach. It's just a matter of whether or not you're right at predicting when momentum is shifting. And it takes time to be able to make those, to spot those small little indicators of momentum shifts. Some of the indicators, of course, are seeing dojis or topping tails, at the top of a run. Others are false breaks over half dollars and whole dollars. This right here made a false break over 36.50. It broke over the half dollar and then it quickly rejected that level. So that right there, to me, if I was watching this and I saw it break over 36.50 as it came back down below that half dollar, I would have considered a short at 36.50 because I would recognize that we're breaking below support. And since we just broke above it and now we're coming back below it, it's showing that that was a hard level to hold above. And so there's a good chance it's now going to sell off. So I could short at 36.50, set my stop at 36.51. And in this case, that would have been a great entry. And it drops 50 cents down to $36. Now, a reminder, obviously with all of the strategies that we trade, we only trade extremes. And the rubber band snapback is no exception. Rubber band reversals are stocks experiencing extremes. So from a technical perspective, we're looking for a high RSI or a low RSI, relative strength index. Now remember, I don't use these indicators on my charts, but I use them in my scanners. So I'm looking for stocks when I'm scanning that have an RSI above 90, meaning they're very extended to the upside, or an RSI below 10, meaning they're very extended to the downside. The second indicator that I look for is a candle outside the Bollinger Bands, and I'll show you examples of that in just a moment. And the third is I look for 5 to 10 consecutive candles, consecutive green or consecutive red, ending with a pin bar or a doji at the top, or a hammer. That would be okay too. So ending with a candle of indecision, or a candle indicating a possible shift in trend. Okay? So today you're going to learn how to find reversal setups using stock scanners, how to read the Bollinger Bands to find the extremes, how to use pin bar candlesticks to take an entry, how to understand where to set your stop and where to set your profit target, and how to trail your winning trades. Okay, so to find these setups, we use our simple high-a-day and low-a-day scanners with RSI filters. Now, in Class 9, I'm going to walk you through actually setting up these scanners, how to build them, and I'm going to share with you all of my settings. But for right now, I'll just pop this over here and pull up one of my scanners. This is one of my scanners from today. So this stock had a 5-minute RSI of 9. That's a very low RSI, okay? Low RSI, but we only had 4 consecutive red candles, and I prefer 5 or more. So this one wasn't quite set up yet, but it was getting there. This one has 12 consecutive red candles, which is very interesting. That's why it's in yellow, but the RSI was 21, so maybe not quite perfect. And then look at this guy. 7.5 RSI, so it's very weak, with 9 consecutive red candles. That's looking a little more interesting, all right? So this is the scanner that's running all day long, looking for stocks that meet my criteria. We've got MSCC here, 11 RSI, which is very low, 8 consecutive red candles. Here we have ALR, a 97 RSI with 8 consecutive green candles. Okay, so these are stocks that are worth watching. These are stocks that are at extremes. It's at least worth pulling up the chart and taking a look. Is this stock extended? Does it fit the criteria of what I'm looking for? All right, so let's see. Well, we'll jump into that in a second. We'll come back to both of these in just a moment. I'm just going to slide this over here for now. All right, so using these scanners, these are already set up, and so you'll be able in Class 9 to install these scanners running the same as mine, and you'll be able to start seeing the RSI, the 5-minute consecutive candles, the volume, the relative volume, etc. Now this scanner here is simply looking for super, super high or super, super low RSI. And that is a helpful scanner because if a stock has a 2 RSI, it's almost as weak as it can possibly get. So there's a good chance that, off that level, it will reverse. I also have this second scanner here, which is looking for 1-minute reversals. So this one is looking for 5-minute reversals. You can see the 5-minute right here. And this one is looking for 1-minute reversals. So here we're looking for 8 consecutive 5-minute candles. And here we're looking at the number of consecutive 1-minute candles. So we can trade on both time frames, but of course the 1-minute is going to be faster moving, a little riskier, although I actually prefer it because the trades are faster and I usually get a pretty instant resolution. So we find these setups or these potential stocks that meet our criteria using scanners. So that's how we find them. All right. Now, the reversal setups that I trade, these are the 5 different types of rubber band reversal setups. Number 1 is a candle outside the Bollinger Bands and or a pin bar. Number 2 is the first candle to reverse after 5+ red or green candles on the 5-minute chart, 5-minute candles. Number 3, the first candle to reverse after 10+ consecutive red-green candles on the 1-minute. Now, this is important. If I'm going to trade a 1-minute chart, I need more confirmation because 1 minute is a little riskier. So I need to see more consecutive candles. And I'll explain what a pin bar is in just a moment. Number 4, over or under the whole dollar or a half dollar. So just the way we get in whole dollars or half dollars on momentum stocks, we look at those levels as potential places to take a reversal. Because we know if a stock has been super, super, super weak and then it starts to pop up and it breaks over a critical psychological level like a whole dollar, that shows strength. If the stock is truly weak, it'll be selling off, it'll come up to those levels and it won't get over and it'll roll over. And it'll keep coming up, hitting them and rolling over. So if it finally comes up and breaks through that level, that's the spot that we say, you know what, I'm going to take an entry right there at the half dollar or the whole dollar. Okay, so that's setup number 4. Setup number 5 is a reversal off daily support or resistance, which is also important because if a stock is squeezing and we suddenly hit a critical daily level, like the top of a gap or the top of a window or a level where we've seen a lot of resistance in the past, we could reverse off that level. So remember, any of these reversal setups can be applied to parabolic stocks, but with parabolic stocks, it is best to wait for the most obvious trend shift because the risk is just so much higher on stocks that are making parabolic moves. So the reversal trading process. Number 1, find the stock on your reversal scanner. Number 2, check for news and break down the daily chart for support and resistance. If a stock is selling off really quickly, you might want to check to make sure they're not, they didn't just announce they're going into bankruptcy because you don't want to buy that for a bottom bounce. So just double check to see if there's news or anything like that. Number 3, choose a potential entry based on one of our setups that we're going to discuss in a moment. Number 4, now that you know the price you want to enter, you're watching the level 2 and the time in sales to confirm the flow of buyers and to confirm that there's no big sellers on the ask in the case of going long. So if I was getting ready to get in at the whole dollar, if I saw a 50,000 share seller there, I would be like, nope, because it's going to hit it and sell off again. So I'm going to watch the level 2 once I understand the price that I want to get in the setup at. Number 5, once I'm in the trade, I'm watching the level 2. But I also check back at the chart and keep checking the low of the last candle. So when I get in a stock that's turning around, I'm checking the low of the last candle and I'm going to keep using that as my stop. So low of day is my stop. And then if we start moving up, the low of that last candle is my stop. And I just keep trailing my stop up. I'll start selling when I hit my first profit targets. And Joanne, a parabolic stock is a stock that basically goes straight up. It goes from like $2 to $4. It goes up more than 50%. Your profit targets on reversals are going to be a lot more conservative than your profit targets on momentum stocks. You're very rarely going to get 2, 3, 4-point reversals. Reversals are usually about a short-term correction back up to a moving average. So the first target is the 20 moving average on the 1-minute chart. Second target is the 9 moving average on the 5-minute chart. Third target is the 20 moving average on the 5-minute chart. Fourth target is the VWAP, the volume weighted average price. Sometimes we get to the first target and then we get a reversal indicator, we get an exit indicator because it's starting to roll over. Sometimes we make it strongly up to the second or third target before we see any sign of pullback. Exit indicators for all of the reversal strategy trades. So I prefer immediate resolution of a reversal trade. If I'm getting into a trade and I'm predicting a reversal in trend, it's got to turn around right away. I don't want to get in and have the stock drop another 40 cents. That just tells me I'm completely wrong. So if I get in expecting a bounce and we don't see the bounce immediately, I'm going to get right back out, right? Because it means I timed it wrong. So if I'm getting in to scalp the bounce off the low, I'm going to be watching the time and sales and the level 2 very closely. If you're trying to do more of one of the trend trades on the 5-minute chart where you think that, this is a bounce off daily support and this could go up for the rest of the day, then you're going to be basing your stop on more of the low of the last 5-minute candle and not as much as what you see on level 2. But for me, I'll begin to sell if I see heavy resistance on level 2 in the form of a really big seller. That's if I'm long. If I'm short and we see a really big buyer, then that is again a heavy buyer is going to be something I want to get out of the way for. So big buyers or sellers on the level 2 will continue to be a concern. Number 2, if I see buying and then all of a sudden things just kind of, flatten out and there's nothing, that's an indicator to get out. If I'm seeing buying and then all of a sudden things shift and I'm seeing a lot of selling, that's an indicator to get out of the way. If my first, second, or third profit targets are hit, I will start selling into that into the squeeze, into the momentum of the reversal. Number 5, if my entry is on the 5-minute chart, I'll typically hold until we get one candle on the 5-minute chart that goes the other direction, starts to go back down with the trend. And number 6, obviously, since I'm expecting an immediate breakout, if we don't get it, I'm out. So remember, this is still breakout or bailout trading. We have to look at this as being, the spear fishing. That you go in, you get it, you get out. If you miss, if it's not right, just get out of the way. These are trades, when you're trading against the trend, you have to be so careful because, you're trading against the trend. The trend is going down and you're buying the stock. So that can work, but you have to be mindful of the risk. Now, a couple notes about the overall market. With reversals, the overall market is actually more important. With momentum trades, it's not as significant. But with reversals, there is something there. So if the entire market is selling off, as we saw today, this afternoon, we had a sell-off in the market. So let me pull this up here. So we had a sell-off in the market today. Market sold off a bit. And that's why all day today we only had like 5 stocks hitting high of day, reversal scanner. And the rest were, for the most part, let's see, this is the one that I meant to grab. And the rest of them were bottom bounces, stocks that were really weak. Okay, so that with all of these stocks hitting the bottom bounce scanner, you have to think, okay, well, if the whole market's weak, lots of stocks are hitting the bottom bounce scanner, so I just need to be a little more cautious and at least mindful of what's happening in the larger market. Now, if you get one of these setups that's just a perfect setup, so there's a lot that are kind of so-so. 4 consecutive red candles, big deal. I mean, look at the overall market has probably 4 consecutive red candles. So that's not as big of a deal. But if you start to see one that's a really good setup, 6, 7, 8, 9, 10 consecutive candles, that would be the one to go for. And if you see that one's starting to bounce, and you go for it, you take the trade, keep an eye on the market. If the market starts to bounce, it will help your position. If the market goes back down to low a day, it could hurt your position. And so that's the one time when you want to keep the overall market up. But you can still have a really solid reversal and have the market continue to sell off if that particular stock is strong enough. Now, in addition to understanding overall market weakness, it's also important to understand sector weakness. So if you have a really weak sector, like all the airlines are dropping, and you're watching this and you see, you see JetBlue and you see Delta and Southwest, and you see them all hitting the reversal scanner, you're like, okay, four of these airlines are selling off. So you look at all four of them and you decide which of them has the best setup, which of them has the most consecutive red candles, which of them has the lowest RSI. And also you could say which of them has the biggest range, which of them has dropped the most, and then therefore has the most room to bounce back up. So you look at the four, you decide which one you like the best, and if you start to see one or two of them begin to reverse before your favorite one reverses, you can often get in because they will sort of all follow each other. The whole sector will start to bounce off the low. We've seen this also, airlines is one example. You see it with oil stocks. You can see it with commodities, with gold. You could see it with healthcare stocks, biotech stocks, etc. All right. So, and yeah, when I'm talking about the overall market, I'm using the SPY. So this is a good indicator of what the overall market's doing. And so this is what I would watch here. Okay, so with that said, let's look at the first reversal strategy. So the first one is a candle outside the Bollinger Bands. So remember when we talked about the Bollinger Bands in class 4, 90% of the price action will occur in between the Bollinger Bands. So if there's a candle up outside the Bollinger Bands, it's indicative of an extreme. The stock is experiencing extremes. And there's a really good chance that out of those extremes, we will make a correction and come back down. So I look for the candle to be up outside the Bollinger Bands, and then the first candle to switch directions and break the low right here is my entry. So I would short right here. Now I'll show you some examples where I might short earlier. If this right here was like a whole dollar, I might take a starter at the whole dollar, because I know, if the stock breaks that level, considering how extended it is, and just breaking that level is a sign of weakness, that could be a good place to get short and have an early position. And then I could double my position when we get confirmation on the 5-minute chart. The 5-minute confirmation will be the first 5-minute candle making a new low. Or if we're trading the 1-minute chart, the first 1-minute candle to make a new low. So the Bollinger Band setup. Candles must be outside the top or bottom of the Bollinger Bands. This helps define extremes. The entry is the first candle to make a new low for candles that are going up, or the first candle to make a new high when you've got a downtrend. Time frame is from 10 a.m. to 3 p.m. The reason I wouldn't trade this before 10 a.m. is that you only have 25-minute candles that form each hour. So if we want to see at least 10 consecutive 5-minute candles, that's going to take from 9:30 to 10 a.m. to form. So although maybe you could take a trade at like 9:50 or 9:55, usually after 10 a.m. is better. So 10 a.m. to 3 p.m. I generally avoid the first half hour and then the last half hour, the last hour. Stock type, the float doesn't really matter too much with reversals. If you trade a stock with an 800 or a 900 or a billion share float, then it's typically a stock that's going to have a lower ATR. It's not going to move as much, and so the range is going to be lower. So under 100 million is probably preferred. Under 200 million is good as well. Under 50 million is fine. That's great, but we don't need to have super low float. So low to medium float is fine. The range today, ideally we should be up at least 5%, 10% is better. That'll be more extreme. Requirements are a minimum of 5 consecutive candles on the 5-minute chart, but more is better. Volume is spiking. If I'm going to take a 1-minute entry, I need to see 10 or more consecutive 1-minute candles, but I'll show you that strategy in a second. Preferred price range is between $20 and $100, but you could potentially trade this on a lower price stock, or you could trade this on an even higher price stock. Entry, first candle to make a new high when it's a bottom bounce, or the first candle to make a new low when it's top reversal. Your stop is always low of day or 20 cents, whichever one is closer. Profit targets are your moving averages. Okay, so your profit target is a bounce up to the moving averages. How do we find these stocks? On our reversal scanners. The low RSI scanners, the consecutive red to green scanners, red or green candle counting scanner, or even a high day scanner. Now I use the same order entry window to enter my share size and my position because I've got time to think about it. I don't use hotkeys to buy these positions usually because I have time to kind of watch it forming, thinking about it. Okay, this is probably going to be my entry. So in that case, I just go ahead and I type my price in here and my share size. I always start with smaller size on reversals, and I very rarely take more than 5,000 shares. Very rarely, especially on a high price stock. All right, so let's look at some examples. This right here, these are the Bollinger Bands, this purple line right here. So this candle is below the bottom Bollinger Band. All right, so you've got the sell-off. It's a hammer candle, hammering out the bottom. Your entry is the first candle to make a new high, which is over 77.75. From 77.75, we pop up 50 cents. That's not bad. Low of that candle was 77.20, which is 55 cents. So I wouldn't use a 55-cent stop because that's too far away. I would instead use, in this case, a 20-cent stop. I mean, a 20-cent stop is probably the best you can do. So 77.55 stop. Profit target is 78. That's 1-to-1. If we can get over that level, we want to see it hit the 9 moving average. So the interesting thing is that when I trade reversals, I have a fantastic profit loss ratio. For a long time, my reversal profit loss ratio was 3-to-1. And it's because when you're getting in stocks right off the lows, your stop is usually really tight, as long as you stop out if it goes to low a day. But then the profit potential, if it bounces back up, is a move all the way back up to your moving average, which in this case was, only 50 cents, but still, when your average winners are 50 cents or 60 cents, that's a lot better than, 20 or 30 cents from momentum stocks. All right, so that's SWKS, 5-minute reversal. This right here is a very nice reversal trade. You've got all of these consecutive green candles. This is the pin bar. So a pin bar it's just another word for a doji, but a doji specifically at the very top of the run. The very top of the move, we can sometimes call that a pin bar. So your stop would of course be high of day, and your entry would be the first candle to make a new low, which is this red candle as it breaks down. So your short here is around 46.70, and you come back down all the way to 46.11. So that's a nice 60-cent reversal. We saw this right off our high day scanner. We have 9 consecutive green candles. RSI is 79, so it's not as high as we'd like, but because we have 9 consecutive candles, this is just so obvious. I mean, you can see it. That many consecutive candles with this pin bar doji at the top, it's bound to roll over. I don't have the Bollinger Bands turned on this chart, but if you did, you would see that this is up outside the Bollinger Bands. It's breaking the top of those bands. Even if it wasn't, the fact that you have that many candles in a row is very significant. Here's another top reversal with a pin bar, the doji at the top. So we've got 2, 4, 6, 8, 9 consecutive green candles. I'm not looking at daily pivot points. I'm not doing anything like that. This is very simple. No fancy indicators. We're just looking for the first candle to make a new low. Stop is at the high. RSI here on this one was 84. So, above 80, not quite at 90, but, it's decent. Obviously, above 90 and below 10 is ideal, but this is when we got into some pretty heavy extremes. That's why those arrows are there. So you've got 1, 2, 3, 4, 5, 6, 7, 8, 9 candles. The first one to make a new low, and then you could have been short right around 2170. Stop is high a day, which is 2185 roughly. So 2185, 21, that's a 15-cent stop. And now here we come down to 2143. So, a nice 30-cent return. That's not too bad. 2-to-1 profit loss ratio. This shows our Bollinger Bands, and you can see how when you start adding Bollinger Bands, and this has MACD on it for some reason, the charts get crowded. They start to get a little bit busier. And just to go back to these two, your first profit target on both of these was the 9 moving average, this gray line. As soon as it taps that 9 moving average, you're taking your profit. So you look at this and you ask yourself, what's the distance? If the distance from here to here is only 3 cents, you don't take the trade. And that's why you usually don't take these trades on like, $4 or $5 stocks, because the range is not big enough. But in this case, the range was 65. Well, no, I guess the range was about 35 or 40 cents. That's more than enough to give you a good profit, right? So that's what your profit target is, right down to the 9 moving average. Correction down to the 9 moving average. If they go further, that's fine. First target's the 9, second target is the 20, and third target's the VWAP. This happens to be a case where the VWAP is above the 20, so that's fine. Target there would be VWAP. So here we go. First target would be the 9 moving average. You've got the pin bar up at the top, so you would be short there, stop at high a day, and then you get 1, 2, 3, 4, 5, 6, 7, or 6 red candles. I mean, that's a really nice pullback from $92 down to $90.50. So it's a $1.50 reversal. Now, even if you only took 150 shares, you could easily make 150 bucks because this had such a range. So yes, you are going to tie up more money. These are higher priced stocks, but you can scale down your position size knowing that they have more range. So that's kind of how you compensate for it. Now, for me to hit a $10,000 winner on this type of stock, the range is 1.5 points. Well, we have parabolic stocks under $10 that squeeze up 1.5 points. So with 10,000 shares of, a $9 stock, I could put $90,000 in and make 10%. To make 10,000 on this, I would have had to take 10,000 shares. That's $920,000 in the trade. I can't do. I mean, I don't have the buying power to do that. And even if I did, I don't want to expose myself to that much risk. So it's this strategy may not be as good for account growth, but if your focus isn't necessarily on account growth, but simply 200, 300 a day consistently, this can certainly be good for that. Here's another one, and you can see once you start to visualize this, when you see the perfect setup, you'll have a hard time not trading it because you'll be like, wow, we've got 2, 4, 6, 7 green candles, and we've got the doji up here at the top, or the pin bar, whichever you want to call it. My short would be the first candle to make a new low. So as soon as this red candle broke the low of this doji, I would be short. My target is the 9 moving average. So this right here is 97.40, 97.45, or right around 97.40. The 9 moving average is at 97.15. So you've got 20-cent profit target, use a 10, 15-cent stop. You could stop over 97.50, over the $0.50, something like that. This one opened a little higher and then sold off, so you'd be short there, covering on the move back down to the 9. This is another one. You've got 2, 4, 6, 7 green candles with a small little doji up at the top, or pin bar. You're short on the first candle to make a new low. So the low of that candle is 56.67. Your 9 moving average is 56.48, or 56.62. So on this one, you don't have a lot of range. So this is one where you'd kind of be like, well, realistically, this didn't move up that much. So even though it's a good looking pattern, the range probably isn't enough to justify the trade. This one we already looked at. It's in here twice. All right, so this is a top reversal here. So on this one, we can see, this is really blurry for some reason. I don't know why, but in any case, we can see the stock was squeezing up here. And so we had how many candles? 1, 2, 3, 4, 6, 8 consecutive green candles. And right now we have a doji at the top. Now I decided to short right here because I was thinking we were going to break down. I was anticipating the break. And see that? But why would I anticipate the break? Why would I think this might break down a minute before that candle closed? Who has an idea? I could already tell it was a doji. I mean, I knew it was going to close as a doji. Exactly, Joe. Because you could see here, it had already squeezed up that much. So it was very predictable that this was going to be a doji candle. I mean, we only had, 20 seconds left when I got short, and my profit target is the 9 moving average on the 5-minute chart. Okay, so, this is one where, I'm already up, looks like 3,400 on the day. And so I'll make $100 on this, couple $100 on the reversal. It's not the biggest winner of the day, but it's a nice little gain. So let's see. I'll fast forward this a little bit. All right, so I guess I covered that one right around there, $190. And here's another reversal. So this one has 2, 4, 6, 8, 10 consecutive green candles, and I just shorted it at high of day. All right, so again, that candle was a doji. I'm shorting it at high of day, but I also shorted this right at $97. I shorted it at the whole dollar because it broke down below the whole dollar, right? So it squeezed above the whole dollar and then it came back down below. And so I was like, look, I'll short at the whole dollar because it's showing weakness by breaking below that level. So I'm short there at the whole dollar and my stop is just above it. Now you can see it came down to the 9 moving average on the 1 minute, and it is finding just a little bit of support there. So that's something to be just like a little careful of. These moving averages can be support on the 9 moving average, on the 1 minute chart as well. And Joe, correct, this pattern doesn't continue from the day before. So if the day ended with 3 green candles, you don't count them in the candles today. We always start with the candles that's from this morning. So covered that, not a very big winner. I have to be careful because if it gets back up above 97, up above the whole dollar, it's showing a lot of strength. And you can see that green candle kind of bouncing back up. So, these ones, and there it's at 97, so it's a good thing I took the little bit of profit when I had it. All right, this one looks like better quality. So this is a top reversal here on BIG, B-I-G. We've got 2, 4, 6, 8, 9 consecutive green candles. So how would we have found this stock? All right, we would have found this stock right on the scanner, reversal scanner. We see it squeezing up and we think, all right, well, first candle to make a new low will be my entry. So right now I'm watching it. It just broke over 53, which is the whole dollar. And so let's see. Now this one's interesting. Look at how quickly there it went from 53 and it dropped 25 cents. This might be one that I don't end up trading just because it went without me. So let's see, we'll rewind this a little bit. So it's at 53 and then all of a sudden it drops to 91, to 86, and 77. That's how quickly these can reverse. The trend can shift very fast. So that's why anticipating it can be good, because if you get in just a little early, just before that, instantly you're up 20 cents right here. And of course, anyone who is chasing that to the long side, they would be stopping out, right? If someone was buying it up that high and then suddenly it pulls the rug and it drops 20 cents, they would be bailing out, taking the loss. So that is more selling. That increases the drop. So now we've got this red candle forming on the 5-minute chart. We still have room down to 52.30 on the 5-minute chart. So we still have 40 cents of potential, which is really solid. So in this case, we're getting the pullback. down to 62 or 40 cents down. But now, what is this pattern starting to look like? What would you say this looks like at this point? You've got 2, 4, 6, 7 green candles, and then 1, 2, 3 red candles. This is starting to look bullish, right? This is a flag. So even though this is a $53 stock and it's not the typical stock I would trade, when you see a pattern that looks really clean like this, there's no reason you can't flip long. You just have to recognize, again, the potential on it is lower than on the under $10 stocks. But I flip long. I decide to go in. I missed my short, but I get long here for the first 5-minute candle to make a new high. My target is high of day, 53. So I'm in at 52.62 and I'm immediately up 15 cents. At this point, I could put a stop at break even. You know, stop at break even. Don't risk a loss. If it works, it works. If it doesn't work, no big deal. I'm only in with 300 shares. I'm not even being aggressive on this one. But the 5-minute setup is solid. It's the first 5-minute candle to make a new high, which is really good. So right now we're 65 by 70. It's kind of like, okay, is this going to be a false break or is this going to continue? 62 by 67. 64 by 69. So we have the first pop, and now we're watching for a 1-minute pullback, right? We want to see that 1-minute pullback, and we need to go higher. This is definitely the moment of truth, and this is not the strongest setup because on the 5-minute, it's kind of looking like a doji. It's looking like a false break. If I had a bigger position, I probably would get out break even. Because bailout or breakout mentality. I got in this expecting it would go right back to 53. Not that it would pop up 20 cents and then go flat. I wanted to see resolution. Okay, so right now we've got one red candle and a second red candle. And then down we go. So had to stop out and took the loss. So on the 5-minute chart, this now looks like a false breakout. And again, let's think for a second, why would we get a false breakout on this stock? Well, it's a $50 stock. How many traders do you think really wanted to buy the first 5-minute candle to make a new high? Not that many. I mean, it doesn't mean it won't work. And there's an example today of a trade that Mike took that I'll show you a couple times, or I'll show you again later in the class. CRM. This was a good trade. It was a good short off the highs, and then it was a good first pullback. I mean, it was good. It went back up. It was a little choppy here, but it did go all the way, or not all the way back up, but quite a bit of the way. So, you know, sometimes they will, but, you know, this one just couldn't do it. Now, one thing to note is that CRM had a lot of volume in this candle. I mean, it squeezed up with 1 million shares of volume, whereas this one here only had 800,000. So the volume was a lot lower. Not as many traders were watching it. Okay, so in addition to setup number 1, which is buying, you know, looking for the candle outside the Bollinger Bands and then buying the first candle to go the other direction. Setup number 2 is simply buying the first candle to make a new high after 5 consecutive candles, even if it's not outside the Bollinger Band. Now, obviously, if we have 5 or 10 consecutive candles and it's outside the Bollinger Band, it's even stronger. But if you only have 5 consecutive candles and you're not outside the Bollinger Band, it doesn't mean it's not worth trading. You just want to be maybe a little bit more cautious because it shows that you're not really at as much of an extreme as if you were outside the Bollinger Bands. So for the most part, the setup criteria is the same as setup number 1. We're looking for, you know, preferably, you know, low to medium float, up 5 to 10%, minimum of 5 consecutive candles, price between 20 and 100. first candle to make a new high, or possibly half dollar or whole dollar entries. In terms of the volume, Richard, to answer your question there, um, a minimum volume on these would usually be 500,000 shares. More than a million would be preferred though, because it's a higher price stock. So more than a million just confirms that more traders are watching it. Low volume, high price means bigger spreads and usually not very good follow through. So I prepare my orders the same as always, typing in my share size and typing in my price, ready to press the buy button or the short button. I can use hotkeys, but I prefer not to. So this is an example, of course, that we looked at before of 7 consecutive candles. First candle to go the other direction is the entry. So anytime you have 5 consecutive candles, it's worth taking a look at it. So let's pull up, let's see, I'll pull up one of my charts here. So we can look at a couple of the reversals from today and see if they would have met our criteria. All right, so of course we have the CRM trade, which had 2, 4, 6, 7, 8 consecutive green candles, and the topping candle was way up outside the Bollinger Bands. Okay, so this one was really extended, which is why Mike shorted it. So there's a couple places you could short it. You could either short the first candle to make a new low, which is right here at 85.66, or you could short as it breaks through the whole dollar and then comes back down below it, because that's a sign of weakness. So shorting at 86, which I think is where Mike got in, is a better short. And then from 86, it comes down to 84.50. But let's look at, we'll look at that one again when we talk about half dollar and whole dollar entries. Let's look at this one, AFSI. AFSI. So this had 7 consecutive red candles. So the volume on it was 2.5 million shares. But this one did a bear flag. We sold off 2, 4, 6, 7, 8. We never made a new high. Or if we did, we actually did make a new high by 1 penny. So this is one of those ones that if you took that entry, you definitely would have just wanted to get out. No reason to hold it, just get right out, break out or bail out. So you'd be getting right back out of this in at 50, maybe you probably would have been at the half dollar or 50 and stopping right back out at 47. So then as it goes sideways, it drops back down a bit lower. So this one would have been a false break. Let's look at another one. Let's see. ALR. So this one here squeezed up from 40 up to 44. And then the challenge on this, of course, is that this candle has such a big range. A high of 44.28 and a low of 42.23. So I wouldn't take the first candle to make a new low because it's such a tall candle. Your stop, it just shows you the range is really quite a lot. But let's check the 1 minute chart, because there may have been a 1 minute entry on this. So this candle turned into a doji. It broke over $44. So, I don't know if you would have really had time to get in at 44. Maybe you would have had time to get in at 43.50. This one probably just moved too fast to give a really good entry. MSCC. So this one, 8 consecutive candles, but it never bounced. No bounce. PAG, 9 consecutive candles. Really not much of a bounce. It bounced up like 4 cents and then flatlined. So that would have been one of the trades that's kind of break even. You just get in, doesn't work, and you get out. The fact that the market was weak wouldn't probably have helped these ones. All right, we'll check the 1 minute chart, or the 1 minute reversal in a few minutes. But in any case, when you're looking for these setups, you want to see the consecutive candles, and then the first candle to make a new high is a good entry. If it doesn't go immediately, you want to get right back out. Now, one of the setups that I really like is taking a trade when we have 10 plus consecutive 1 minute candles. Because when you trade on the 5 minute chart, you always kind of have to check the 1 minute to see, well, does the 1 minute look good? You can trade just off the 5 minute chart, but if you're shorting on the 5 minute chart, what if you're shorting right at, say, the 9 moving average? You might see a little support there, you might or might not. So I just seem to prefer to trade off the 1 minute time frame. So with a 1 minute time frame, the only thing that's different is that we need to have at least 10 consecutive 1 minute candles. So when I see 10 consecutive 1 minute candles, I prepare my order, and then the first candle to go the other direction is where I get in. So right here, we've got this stock that had, let's see, 2, 4, 6, 8, 9 consecutive candles, which was pretty close. And as we popped up here, we broke over 58, entry at the whole dollar, and from 58 we went to 58.50 to 59 and to 59.50. I mean, that's a really good bounce. That's over a point. So nice return on that, although of course you probably only would have taken a couple hundred shares, you could still make a couple $100. Now look at this one. When we see this, we look at the 5 minute and we see, okay, we've got 1, 2, 3, 3 green candles with a doji at the top. It looks like a good reversal on the 5 minute. We look at the 1 minute and it makes it look even better because you see, look, you've got 2, 4, 6, 8, 10, 12, 14, 15 consecutive green candles. So when you see this, it's just like a freebie almost. I mean, it's like that the first candle that makes a new low has such a high probability of reversing. So generally speaking, when I see reversals that are fake outs, like some of the ones we were just looking at, they usually didn't line up on both the 1 minute and the 5 minute time frame. So this scanner right here for 1 minute reversals is definitely my favorite one. It just gives me the best setups because I know, well, number one, the scanner's already looking for stocks that have 5 minute confirmation. It needs a minimum of a certain number of 5 minute candles, and then it also looks for a minimum number of 1 minute candles. So you have alignment on 2 time frames. That increases the probability that this is going to work. So you see CRM on here, ANSF, and MSCC was on there at one point, but then it ended up faking out a little bit. So let's pull up, let's see, ANFI. Wait, that wasn't it. AFSI. And we'll check the 1 minute time frame. Okay, so the time on this one was 11 a.m. Okay, so 11 a.m. Now, see, when I look at that, right, you have that many consecutive red candles. When I look at that, that to me is like, I want to get in it. But then when you have this candle here, and this candle here, and this candle here, those 3 little dojis in a row, those actually make me feel a little uncomfortable because you want to see when you get that extreme, the snap. So it's like if I let go of this rubber band and we just stay stretched out and nothing happens, it just doesn't seem right. So when I see it just going sideways at the low, I usually just feel like that's not what I was looking for. I want to see, more like, the example in this picture where you almost immediately roll over. Now this rolled over, popped back up, and then moved, but at least it moved. MSCC, let's see, MGA was on here, but only with 5 consecutive 1 minute candles. So that's basically the minimum amount that it can show, and obviously it wasn't very good. This one also only had 700,000 shares of volume, so the volume is pretty light. So having said that, when this went off at 11:07, you had 2, 4, 6, 8, 9, and then look what happened. If you waited and you got in right here at 4:12, this popped up to 4:25. I mean, that's an easy 10 cents. It really is. And if it didn't work, even at, it popped up to 415 and then came back down. So you stop out for a small loss. The low of day on this thing is 409. That's literally risking 3 cents. The risk is so low. I mean, it's just like super low risk versus that profit potential. So you've got a great profit loss ratio, which affords you the ability to take a few of these. And yeah, if some of them you stop out break even or you take a 10-cent loss, it's not a big deal. 2:52 p.m. on MSCC. So that was right around here. Let's see, so 252 is right in this area. This, I don't know. I mean, it would have been a little tricky. Maybe you would have gotten in here for the first candle to make a new high. It did move up a little bit to 58 and then came back down. It wouldn't have been a big loss as long as you stopped out at low a day. You only would have been risking 4 cents on it. So it didn't work super well and the volume was pretty light, but not bad. Ideally, you have alignment on the 1 minute and the 5 minute time frame. So then in contrast, if we look at some of these ones that were just on the 5 minute time frame, the 5 minute chart, ALR, that was on the 5 minute only, which we looked at. The 1 minute was not enough consecutive candles, probably too choppy. Let's see. Page, PAG. This one around 3 p.m. was selling off. Didn't have enough consecutive candles at that point. Even though the 5 minute was set up, the 1 minute wasn't good. And when you looked at that 1 minute, you would have thought, doesn't seem ideal. This CVI long stretch here, this was at 330, 327, but at that time, it didn't have enough consecutive red candles on the 1 minute, so it wasn't quite set up. Some of these other ones like Dove, DOV, Dover Corp, the 1 minute doesn't have that nice long stretch. So I would encourage you to print out a chart just like this one. And the next time you see a stock that has 10 consecutive green candles or red candles, watch it really, really closely. In class 9, I'll give you these scanner settings here, and you can start running the scanner. In the meantime, you can run it. You can just watch it on screen share, but you'll be able to run it on your own system after I show you how to use it properly and how to configure it. And you'll be able to set up these awesome alerts where this gives me an audio alert. So it can, let's see, it can do text to speech where it reads the symbol out loud, or you can do a custom sound where you make it, play a bell or there's a bunch of little sounds, a little ding. You can add any sound you want, I suppose. But these are audio alerts. So I can be sitting here and then all of a sudden I hear, bing, and I look and I say, oh, there it is. I got to take a look at that one. Does that make sense? I mean, this is different from the momentum strategy, for sure. These are higher price stocks. These aren't stocks that you would usually feel comfortable taking, 5, 10,000 shares of, but these setups are really obvious. They give you lots of time to see it forming and to wait for that first candle to make a new low. I'm going to pull up this video here. Ideally with these, you actually, news is not very critical at all. You don't need news with these ones. If you have news, it could almost be more of a concern because it shows a reason why the stock is so strong or so weak. Now, Rachel, you can absolutely trade. If you find a stock under $10 that has 10 consecutive green candles, absolutely, you can totally trade that. But it's not as common. Just simply literally, this is looking at the entire market today. There were only 1, 2, 3, 4, 5 stocks that had all the criteria that I look for reversal. I mean, the entire market. And I don't think I'm filtering out low price stocks. That's just the only ones that met my threshold. So it's such a finely filtered scanner that you have to cast a wider net in order to get results. All right, so this is a, let's see, a reversal example. So this is a strategy that I really encourage, side by side with momentum strategy, because if you keep a tight stop, if you understand your max loss, it can be a nice way to, pick up some small wins here and there. Okay, so let's see. So here we've got 2, 4, 6, 7 consecutive candles on the 1 minute chart. Plus we have 4, 6, 8, 9 consecutive red candles. So on this one, I'm getting in a little before the 10th candle. Again, using my discretion a little bit, but I'm watching this CLVS. And here's the thing. What's my first profit target? My first profit target is the 20 moving average on the 1 minute chart. And how far away is that? The price right now is 58.18. The 20 moving average is 58.29. I've got over $1 of room for this bounce. I mean, that's a lot of room. On a stock that's $10, this is probably only 20 cents at most. But in this case, we've got range. So that's why I'm like, okay, this one, if it works, it could be a really good trade. So I'm watching it over the $0.50 because look, the high of the last candle is 58.50. But I'm also watching for the first 1 minute candle to make a new high. We've got 8 seconds left on this current 5 minute candle. High is 32. Here's a little buy. A couple orders went through at 28. Now we've got a seller at 22, 25. We're dipping down a little bit. So now I'm thinking, what if we dip below $58, the whole dollar, and then we come back up through that level, right? Okay, so there we go. We just dropped below 58. Okay, we broke below 58. Now I'm watching this to come back up through that level. If it can get back through that level, that's a real sign of strength. That would be a false break of the whole dollar. False break and a reversal coming back up. Now, Arthur, I didn't get in at 59.50 yet because we haven't had a 1 minute candle make a new high. So we haven't had that opportunity yet. So now I'm watching to get in at $58. As soon as I see a little buying coming back up, now this could just keep going to 58, 57.50. It could just keep selling off, but I'm watching for that reversal. 57.50 on the bid. Also notice that the best reversals have the high volume at the low. So the volume peaks on the sell-off as the momentum shifts. And there we go. As we came back up over the whole dollar, I got in at 58. Now at this point here, my stop is low of day. So on this one, I've got a bigger stop because low of day is further away. Now, although using an arbitrary stop of 57.80 would be nice, on this one, it's not super realistic because of how much range it is. So in that case, when your stop is going to be bigger because the range is so big, usually you use smaller size. I'm watching for the first candle to make a new high. This isn't exactly what I wanted. I wanted to see it hold above that whole dollar. Not break it and drop, but hold. Okay, so now we're watching for the first candle to make a new high, which will be over 58.18. There we go, 58.24 on the ask. So now we have our first candle making a new high, and look at how quickly we went to 31 by 44. Right? That's fast. All of a sudden it's like, boom. First target is 58.98, which is our 20 moving average. There's 45 by 69, 54 by 69. I'm up 524 bucks. 70 on the ask. So, I'm trading with 1,000 shares, which is, fairly big size, but if you traded this with, 100 or 200 shares, you could be making 100, 200 bucks. This didn't give us that perfect doji on the 5-minute chart. That was kind of the only thing that wasn't ideal about it, is it gave us that big sell-off and then that reversal, but not that really nice doji. Low of day was 57.54. I think it was 57.50 or 54. Now we're coming right up to resistance at 58.98, 99. This is going to be a little bit of an issue here. I sold 500 shares at 83, locking up 400 bucks. Now, this was not the perfect reversal trade. But right now, I'm up $1 per share. There's 59.22 on the ask. So it was the right type of stock to take the risk on. Every trade carries risk reward, but this had reward potential, and we could calculate the risk because, when we see these 10 consecutive red candles, we know the first one to go the other direction will be significant. So the 9 moving average on the 5-minute is 59.63. So we're already coming up close to that level. I've sold all but 125 shares. So I'm all out except for 25 shares, which are on the ask, and there they go. $902. Not bad. And how long was that trade? I mean, it was like a 1, 2, 3 minute long trade. So it was still a fairly quick trade, but it gave you more time to think about it and to watch it before it happened. Does that make sense? All right, so let me back out of this. I'll show you how to sell on the ask, but you can sell on the ask using your hotkeys, which is what I was doing, using my hotkeys. And those are, if you're using them in Fantasy Stock Trading Simulator, let's see. It's Control K and Control L and Control semicolon. Let's see. I'll open the simulator here just to show you. Let's see. Okay, so I go to Tools, I go to Hotkey Manager, and then I can scroll down here and let's see, close out 50% of position on the ask, 25% on the ask, 100% on the ask. So those are the ones. Okay, so next one. So number 4 is the strategy, the rubber band strategy of getting in at half dollars or whole dollars. In that video that I just showed you, in addition to having 10 consecutive candles, the entry was based on getting in at the whole dollar, right? I wasn't waiting for I actually got in anticipation, knowing that breaking over the $0.50 right here was critical enough that we should then get the candle that first makes the new high. It ended up being a little bit of a close call because all of a sudden it dropped back down and then it came back up, but it was the right place to get in. When you take a $0.50 or a whole dollar entry, the risk is for sure higher because you're anticipating the change in direction. Now, we're already trading against the trend, swimming against the current. So instead of waiting for the current to start to change, you're getting in as it's still going the wrong way. You're not getting in as it's still going the wrong way because you're not buying as the stock is going down. You are waiting for it to start popping up a little bit, but you're getting in before you have the first candle confirming that's making the new high. So with that said, you may want to size down when you take whole dollar or $0.50 entries, knowing that the risk is a little bit higher when you don't have that confirmation. And then when you get the confirmation of the first candle to make a new high, that would be where you could add. So in my order entry window, I would be typing in my order right around the $0.50 or the whole dollar. So it would be at like, 39.95 or 40.05, etc. Now, this trade today that Mike took on CRM is just a great example because you have the stock that's squeezed up here from 84.50 to 85, 85.50 to 86, and it kind of got that final squeeze, and then it's that point where you shoot a bottle up into the air, it goes up, and then all of a sudden you have that moment of pause, and it comes back down. That moment of pause is right at $0.50 and whole dollars. We just kind of get over that level, and then we come back down. So the short there, a good entry would have been right at $86 with a stop just over the other side. So the same as I bought that stock we were just looking at 58 coming up, you'd be shorting this at 86 with a stop just on the other side. And from here, it goes from 86 down to 85.50, down to 85, and all the way down to 84.50. Okay, so here's another example where the stock has consecutive candles on the 1 minute time frame. We've got 2, 4, 6, 8, 10, 12 consecutive candles. And how much room do we have from the current price up to the 20 moving average? Current price is 79, the low is 79 there. The 20 moving average is at $80.89. We have almost 2 points. That's a lot of range. Now, if I waited for the first candle to make a new high, I would have been getting in right around here at like 79.70. But instead, I let this dip down, and as it surged back up, I got in right here at 79. Now, the reality is I could have done the same thing right here at $80. It drops down, and as it surges back up through 80, I could have gotten in. And so that's the place where if it comes back and makes new lows, you have to get out. You don't want to hold and hold and hold because, what if you do that up here and next thing you know you're at 83, 82, 80, 79? You have to just get out. So it can be a little challenging. That's the frustrating thing with reversals, is that sometimes you do this and it doesn't, you anticipate the reversal and you're wrong. It doesn't reverse. But in this case, if you got in here at 79, that would have worked. Or if you simply waited for confirmation, confirmation is something you have to pay a price for. The price in this case was an extra 70 cents. But from there, with confirmation, we went from 79.70 to 80 to 80.50 and to 80.89. We went right up to resistance. So you still had potential even if you decided on this one to wait for confirmation. If I get faked out once, I'm going to be more inclined just to wait for confirmation on the next trade. I don't want to get faked out 2 or 3 times in a row. So that's, the risk with the $0.50 whole dollar entries is that you can get faked out. Here's another one. This one was on our reversal scanner, selling off the consecutive 1 minute candles, flushing below 24.50, and as it came back up, the reversal from 24.50, this was also the first candle to make a new high, the green one right here. So this was a decent entry right here with a move back up to 24.60, 24.80, and 25. This is kind of ideal when you have the first candle. When the confirmation is really close, that makes it feel safer. In this case, the confirmation to get in at 80 right here, I mean, you knew the confirmation was to make a new high, and this candle right here, you would have had to go all the way up to 81. So it would have been really far away. In this case, the confirmation getting in at 70 was still far away. So some of them just set up perfectly, and others are going to be a little bit more difficult, not for any really logical reason. Here's Sina, bottom bounce, $half entry. So we get the sell off here, 2, 4, 6, 7, 8, 9 consecutive candles. First candle to make a new high, and there we get the move from 47.80, but with an early entry at 47.50. So in at 47.50, and then you have the move here up to 48 and 48.50. This is going to be a top reversal on LJPC. And I took one red trade on it, and then I had one green trade. So on this one, I'll have that example where I got in for the first attempt, it failed, and I had to try a second time. Let's see. So LJPC I'm watching over here. I haven't updated my chart yet. I'm watching to short it, and I'm watching below $34. Okay, so here we've got, 2, 4, 5, 6 consecutive green candles and a little doji up here. So that's why I'm like, okay, I'm going to short at 34. 500 shares at 34. And there we drop down. That looks good. And then all of a sudden, we're going to pop back up. 34.07. It looks good. It just wasn't quite ready. And, here I'm like, oh boy, I got to get out. So I stop out. I get a little slippage. Look how quickly this thing, squeezes up. So I lost about 25 cents on it. But we didn't actually get 1 minute confirmation. We didn't get that 1 minute candle to make a new low. So I was anticipating it with a little bit of an early entry, which sometimes works. In this case, it didn't. So now I'm kind of like, okay, I'm watching it either around $35 or $34.50. I'm still watching half dollars and whole dollars to kind of find that entry. So at this point, I'm just waiting for the first red candle because that red candle will give me the confirmation. Here we go, $35. That's why you cover. I don't want to lose 500 bucks, right? This continued all the way up to 35. I was early, and that's okay. Take the loss, get out of the way, let it continue to run. The tide hasn't shifted yet, but here we go. This candle looks like it's a doji right now. This is the one that came up to that whole dollar, and it appears is finding resistance at that level, which is why, it would have been not a bad entry to get in at 34.90, but I want to wait for confirmation, especially after the first fake out, waiting for the first candle to make a new low, and there we go. Now I'm short. First candle to make a new low right here. But I took the same size as my original trade. So now I need to make 25 cents to get back to break even. So it's like now I kind of have positioned myself in a little bit of a tricky spot. I waited for confirmation, got the confirmation, so now I've got a good position here, 35.60. Stop is at the high of day, which is another, 25-cent stop. Target is a move back down. The 20 moving average is at $33. So I'm looking for a move to 23. So I'm up, 30 cents on the bid. So we got our first candle to close red, which is great. So now 22, 17. Now be careful because look at that big bid. See that 23,000 share bid? That made me a little nervous. So that's why I covered half. I'm worried that that guy's going to hold. And then look at that. This was like the worst luck ever. I covered right before it flushed down to 33.90. I covered at 34.17, 34.14. So a little annoying, but now I'm up 50 bucks on the name. So you can see here, you know, I was a little early on my first try, and this could have gone 3 more points. It could have gone 4 more points. You know, obviously if I'd held, I would have been back to break even, but you don't want that to take that approach because these can go and just go and go and go. You got to get out, get back in. Now, sometimes when I get back in, I'll take more size if the second trade, I think, or the second setup or third setup to me just looks better because now it's more extended or now the setup is just stronger. If that happens to be the case, I could be more aggressive. I didn't want to do it on this one because, you know, by the time I waited for confirmation to get in at 60, it was already dropped 40 cents off high a day. So I didn't feel as confident, but, you know, it's still a decent trade. So let's see. So that was LJPC. Now we'll look at a 10 consecutive green candles on QCOM. And this one might also be a $0.5 whole dollar entry. It should if it was in this category, but we'll see. Oh, no, this one's actually, yeah, this one's in the wrong category. I'll move this slide later. All right, so here's the one we looked at before, 4 candles. Look at all these consecutive green candles. This is at $58. Oops. So watching short below $58. I'm short at the whole dollar, short at 58.03. Now I'm expecting it to break the whole dollar, so right now I'm a little bit iffy. Is it going to break? I also have 2,000 shares, which is $110,000, $120,000. So first candle to go red, needs to break 58. It's holding support there. I'm typing in 2,000 shares, and I'm typing in 58.06, and I'm hovering over the buy button. I'm ready to bail out, and okay, there we get the drop. So now my stop is break even, because if it drops below the whole dollar, I certainly don't want to see it get back above that level. So now I'm risking basically $0. I'm up 160 right now on this trade. So 57.62 is the 20 moving average. So it has about 40 cents of potential. I'm up 240 bucks there, 220. Haven't covered any of it yet, but I want to cover soon because I'm holding 60,000 or $120,000 of, you know, stock short. Notice on this one that we came up on the daily to the 50 moving average and then started to turn around off this level. Now I could have set a live stop at 58. I could have with the Control B button. I didn't because I've just got my hand right here on the mouse. And right here I'm about to cover. I'm like, oh boy. Look, I'm even clicking on this. All I have to do is lift my finger. So you see how I've actually pressed the button down and I haven't lifted my finger off the mouse yet. So then if I move my mouse away and unclick, I'm no longer clicking the button. So right now I'm like, so you see how I moved over there? Watching the level 2, watching the time and sales, feeling a little nervous. The The 5-minute setup is great though because we have that doji. So this was a spot where we saw it dip down and then we saw it come back up to 58, and then it's going to roll over. So it gave us a little bit of a scare. So it's still kind of hovering there, longer than I like. And obviously, when we talk about breakout or bailout, this is like, you get into a trade expecting it to drop 20 cents, expecting an immediate resolution. So when it's just sideways like this, it's definitely not what you are looking for. Now, the problem with this, well, it's not a problem. The reality of this strategy is that you may not find a good reversal every day. So if you're trading reversals like this, you may only find one, or you may only find 3 a week or 4 a week. It's not likely you'll find 3 or 4 every single day that look this good. It's pretty unlikely. So, that means you're trading a little bit less, but again, you focus on A quality setups and the gains, will just be slow and steady. Okay, so now I'm like, all right, I got to cover half of this. I'm back up to up $200. So I changed this to 1,000 shares. New stop is 95 in my head, so I typed in 96. And here I'm going to cover. All right, there we go. Now I'm up $400. It's time. I tried to cover at 84, didn't get filled, so it covered at 87. $150 locked up. Now I've got 160 still open. But note that the longer we were going sideways, the more that 20 moving average came up. So now I'm almost at my profit target at the 20 moving average. So that kind of has reduced my potential on this trade to the point where I'm probably just going to end up covering a little sooner. Because, yeah, it is consolidating. The 5-minute, though, look, the 5-minute's floating up in kind of no man's land. Remember how we'd like to have those setups down to the 9. So this one's still way up here in the middle of nowhere. Those are all my routes I can use, all the different routes. I'm setting a stop order. This is rare for me. I'm setting a live stop order at 57.95 and set it and forget it. So live stop order is set. Now I can just let this thing do its thing. I covered, I guess, another 500 shares at 58. So I've got $220 profit and $80 unrealized profit. And I'm up 2,400 on the day. I'm not selling based on my profits. I'm selling based on the level 2. If this thing dropped and showed absolutely nothing, no support until 57.50, I probably would have just held the whole thing. I mean, at a certain point, if I'm up a lot, I'll start to say, okay, I'll take half off the table. But I'm selling here because the level 2, you know what? I'm selling here because I've been holding it for a while and it's not really doing as much as I thought it would, so it's time to take some off the table. It's not really the level 2 that's making me sell at this point. At this point, it's just kind of, it's hitting my profit target here. So I canceled my sell order, my stop order, so I can cover another 250 shares. Covered at 82. So now I've got $270 locked up and another $50 unrealized. So my new stop is going to be the high of this pivot right here. So I'm putting a market stop at 57.91. Now, a market stop, is going to obviously take me out at market price. There we get that nice drop down to 68, 70. So it'll take me out at market price. Covered another 125 shares at 69. Now I've got 312 in profit, and I'm still holding 125 shares. So just kind of slowly scaling out, putting out these stops. Obviously, if I'd held the full 2,000 shares, I'd be up $600 right now. So my profit would be doubled, but it also could have gone right back to 58 and I would have made 0. So that's where I scale out. I take profit along the way, scale out, lock up some gains, because that's a smart thing to do. Now this on the 5 minute is starting to look more like a bull flag, and that's going to be a little bit of a concern. So 69 by 70. We're under the 20 moving average. We broke that level. So once we break that level, the next target is the 9 on the 5 minute chart. The only reason I'm able to get this price here to follow the ask is by clicking on the ask. You click on the ask and it'll update it right there. Now again, this stock is only down 30 cents from my entry. It's not the most incredible move that we've ever seen, but it was pretty low risk. And I mean, I was only risking about 5 or 6 cents. So, the risk was pretty minimal for $300 profit. So I cover the rest at 74 as we started to break up here. This could have been a long entry, but again, how many people are watching this to get long? It's a $57 stock, 3 million shares of volume. I mean, really? I don't know. It just, to me, doesn't seem like it's that good of a long. But it's an okay short because it was so stretched out. So it was at extremes. Now, that setup there, where it was coming back for the long setup, was not really an extreme. I mean, it was just kind of moving back up. And I'm going to back out of this. I got to move that QCOM example up to the right place in the slides here. I don't know how that one got out of order. All right, so that one's in the right spot. All right, so here we go, LJPC, and now we've got a bottom bounce on VRX. Okay, so VRX. So we're watching VRX over on the side right here. Right now we're at 41.55, 41.60, 41.50-ish. We have 45 million shares of volume, and it's down 40% today. Okay, that's a pretty big drop for an expensive stock. I mean, this is legitimately a huge drop. But that means it's a stock at extremes, and I trade extremes. So that's why I'm interested in trading it. So I'm watching this for a bottom bounce. And you can see the range. It just went from 41.50 to 42. So this is a stock that has a lot of range. I mean, it's moving. It's whipping around. So I'm just sitting, waiting. So I just, let's see, got in at 42.34. And let's see, where was that? I got in, I think it was right here. Yeah, let me just back this up for 1 second. So this is 10:30. That's 10:30. Okay. So this was kind of the right entry on this was, I think the right entry on this would have been, and this was March of last year, it looks like. So this was February 22nd, 2016. So this was over a year ago. I think that I can say now with, another year of experience under my belt that this was not the best entry. It was a good setup because you had a stock that had just flushed down to 41 and then popping back up. I think a better entry would have been through a $0.50 or a whole dollar. Getting in at 42.34 was really high. So watch here, let's see. So when we started watching this, we had just come up off of $41, I guess. So we'd come up off 41, 41.50, 41.72. I think the right entry on this would have been $42. So let's watch it at 42. 41.50, I think, I mean, that would have been risky because it's right at the bottom. So just watching the level 2, that's where I probably would have gotten in. See how all of a sudden you saw that shift in buying? That's where I probably would have gotten in if I saw this one today. All of a sudden, 60, 62, 66, 73, 78, that's kind of what you look for. All of a sudden you see that shift in buying. We pop up. Now we're 40 by 41. So I was just like a little late on it. I don't know. I have my order ready at 42.40, and I'm going to get in right here. So I ended up getting in at 34, which was 34 cents a little too high in my opinion, if I'm going to critique my own trade. I double at 42.50 at the half dollar right there. Now I've got 1,000 shares with an average of 45. It's not the best average. My stop is 41 or 42. I think I should have gotten in at 42. I know, however, that over 42.50 is the first 5-minute candle to make a new high, as you can see right here on the 5-minute chart. So this is a good 5-minute setup, which gives me more conviction. Although you can see here I'm down $35. So we're definitely seeing a little resistance at that whole dollar. Down 60 bucks on the bid. Down 100 bucks on the bid. $47 million shares of volume. There we go. 65 by 75. 6,500 shares. There we go. That guy moved. Here we go. So $43 is the target, the whole dollar. 94, 97, 99. Now I decided to add at 99 for the break over 43. I think again that was a little aggressive. Because now my average is 42.63. I really have screwed up my average. And now I'm down 200 bucks. You know, I've added size, and if it quickly drops, my loss is going to be that much bigger. My thought is I'm waiting for this to get back up above 43 to break the whole dollar again, because that's what I think is going to happen. $77 on the ask, 72 on the bid. $72 on the bid, 84 on the ask. Seems to be struggling to get back up above $43. 88 on the ask. 80 by 88. There we go. 43 on the ask. There we go. Sold half. 43.12 by 43.19. Stop is going to be just under 43 on the rest, just under the whole dollar. 20 by 24. And I sold another quarter at 43.05, just before that 20-cent drop. And I sold the rest at 72. So for all of that, I only made 500 bucks. You know, that was not the best trade. I got in a little too high. And, you know, I kept adding. I was adding it to the half dollar and the whole dollar. I don't think that I really positioned myself in the best way on that trade, even though it had a lot of potential. Now, one of the things that's important for you guys to realize is that the more you trade, the better you'll get. And so, you know, for me, I can critique myself looking at this trade a year ago and say, well, I think I would have done this differently today. But on any given day, your aggression and the way you trade can vary slightly. Maybe for some reason I was being more aggressive that day because hadn't made as much money as I wanted to, or something like that. So that was VRX. Now, setup number 5 is a reversal off daily support or resistance. So if you see the stock selling off, on the 5-minute chart, and it's coming down to something like the 200 moving average, that could be a place where we could buy it for a bottom bounce, right? We're bouncing off of that daily support, whether it's a moving average, the top of a window, the bottom of a gap, or the recent candle high, a whole dollar. Those are levels that we can watch. Now, with reversals off daily support, this is kind of like taking the candle that's up and outside the Bollinger Bands. I mean, ideally, it needs to meet all of our other criteria already. It needs to have 5 to 10 consecutive candles. It needs to have high-low RSI. It needs to be extended. If it also has daily support, that's going to make the reversal setup that much stronger. I mean, that's really all it does, is it adds another level of another setup that other traders may recognize. So the more traders that see a setup or see a reason why this should bounce, usually the better it'll bounce. So look at this one, for instance. This is Teva squeezing up and hitting resistance at the 200 moving average. So if you saw this, and on the 5-minute chart, you had 8 consecutive green candles, or you had a candle up outside the Bollinger Bands, you had that topping tail, plus you have the overhead resistance of the 200 moving average, it just adds more strength to that setup. It's adding another one of the criteria for a potential home run reversal trade, as much of as a reversal can be a home run. Now, those are the 5 different ways that you can trade the rubber band snapback. So you're looking for stocks that are extended, first and foremost. They need to be extended. You're looking for, generally, the first candle to move the opposite direction. Sometimes you'll take an entry at a $0.50 or a whole dollar. Sometimes you'll take an entry because you see daily resistance, the 200 moving average or something like that. Those can help you feel stronger about taking an entry. But generally speaking, any rubber band snapback needs to be extended, and in order to justify taking a trade, we need to have at least 5 consecutive green candles on the 5-minute chart and 8 to 10 on the 1-minute chart. When you have both of them, you have multiple time frame alignment, and that is really the strongest setup. So the examples you saw today on Qualcomm, on VRX, on what were some of the other ones we had? We had, I think, CLVS. These were all fairly straightforward trades. They were fairly low risk. How did I find the trades? I found them on my scanners. How did I evaluate them? I pulled up the chart. I looked for those consecutive candles. Once I saw it, I started looking for possible entries. Are we near $0.50 or whole dollars? Are we near daily support or resistance? And how much of a profit target can I realistically get? If we're only 3 cents above the 20 moving average, there's no profit target. If we don't have a good doji, we may not be able to get really good confirmation. So although I may sometimes take early entries, bouncing off of daily support or buying right over a whole dollar or $0.50, I do that because I have strong conviction. The safest setups are always setups that have confirmation, but the risk with confirmation is that the challenge with confirmation is that you usually pay a price, right? Because by the time you get confirmation, the stock is up higher, which means you're paying a higher price for the shares that you want to get. So your winner will be smaller. And if it ends up being a false breakout, the loss will be a little bigger because you're in at a higher price. But then you weigh that against the fact that stocks with confirmation have a higher likelihood of resolving because you got confirmation. I mean, yes, some of them will fake out, but you're much more likely to have a fake out when you're anticipating moves because you may not be good at anticipating those setups yet. That takes time to develop that sense of intuition. It's an educated intuition. It's the ability to look and say, you know what, I think this is the spot, and that your instincts are right. So for all of you right now who are starting to, trade with in the simulator and trade these strategies, I would encourage you to, look at the stocks that are hitting these scanners. When you see them hitting the scanners, pull them up on the chart and start to break it down. We can look at this 1 minute scanner here. Let's go look at this for, we'll do historical data, and we'll look at this tomorrow, or we'll look at this for yesterday. Let's see, yesterday morning. We'll do it this way. All right, so we'll let this get loaded, and we'll look at a couple of these examples. So we're going to be looking at the 5 minute and the 1 minute side by side, and then we'll check the daily chart to see if we have additional confirmation. So I'm going to take these away for a second. And, William, I sometimes will look for news, but only if it's really extreme, like VRX. If it's down 40%, then I'll look for news. But if it's within 5 to 10%, I may not look for news before I take the trade. It kind of depends on how much time I have. When I pull it up, if it's just still forming and I have time to go over to MarketWatch and check the headlines, then I'll do that. So Louis, when I am taking a trade, it's 100% based on technical analysis. It's not the fundamentals, because the fundamentals, right now, does it matter if this stock had good earnings or bad earnings? It's all about the price action at this moment. I don't know why this scanner's loading so slowly, but I'll try it one more time. We'll see if it pulls up more data. Did anyone take any good reversal trades today? The only one that I saw that was good was that CRM trade. Right here. Now, tomorrow when we're talking, or in Class 8 when we're talking about parabolic stocks, we will be talking about a different reversal strategy. The reversal strategy we'll be talking about in Class 8 will be specifically about learning the difference between the front side of a momentum stock and the back side. So that's a slightly different strategy. It's a reversal strategy, but it's not the rubber band snapback. Now, we can still trade rubber band snapbacks on parabolic stocks based on these strategies that we talked about today, but there's a second set of strategies that we can trade specifically on parabolic stocks that I want to go over tomorrow. So yeah, Cali, for instance, this one, it didn't set up a good rubber band snapback, really. You didn't have, in the sense that, did we have 5 consecutive green candles? No. We had choppiness. But this may have given us a different type of setup, which we'll review tomorrow. And this one didn't, it actually didn't really give the best setup in general. But HTGM will be one that we review in Class 8. And we'll be reviewing why, let's see, let me zoom back here. Got to go back a couple days. All right. So in HTGM, this is one where we traded momentum on it. This was a stock in play, and it was worth trading both directions. We had momentum going up, but then by the time it was extended, we kept getting these upper wicks that got reversed, and these kept being fake outs, where beginner traders that wanted to get a piece of the action would buy it, and you get this predictable reversal. Now, the challenge is finding shares available to short, but if you find shares available to short, it's not a bad strategy. This is what we would call this is capitalizing on false breakouts. False breakout and then short. False breakout, short. False breakout, short. False breakout, short. So if you can learn to anticipate where you would get a false breakout, it'll help you, number one, not go long before a false breakout, And number two, if you do have shares available to short, you could possibly take advantage of it to the short side. All right, so we'll cover that tomorrow. It doesn't seem like Trade Ideas wants to cooperate with loading the 1-minute scanner. But the good news is, anytime I take a really good reversal trade, I will be recording it and I will upload it to this section of the course. So you can come back into the class, a week from now, a month from now, 2 months from now, and you'll likely see some new live trading examples. And I want to just keep building those archives up so, you can have refreshers, or if you really want to study this strategy more than some of the others, you can just watch all of those live examples again and again and again. All right, so the steps that you can take today to trade reversals, okay? Now, these steps are essentially the same as the gap and go trading strategy and the reversal trading strategy. Number one, if the 1-minute setup is too fast for you, you can trade the 5-minute. So I love the 1-minute setup, and I think it's better to get 1-minute and 5-minute confirmation. But if the 1-minute is just too quick, focusing back to the 5-minute is okay. Number two, never chase a proper entry. Every trade has a proper entry, and if you miss it, you've got to wait for the next setup to form. And number three, don't be a follower. Just because I take a trade or someone else takes a trade doesn't mean you should just follow them. You have to understand why we're getting in where we're getting in, because sometimes we might be getting in the wrong place. We might just be being impulsive or emotional, and you need to understand that there's a right strategy, or there's a right entry and a wrong entry. So, as I said yesterday, the most important, and I guess I've said this several times along, over the course of the last, 6 classes, you need to find one strategy that's a good fit for you. It may not be reversals right now. It may be trading momentum. It may be buying the first bull flag, the first 1-minute pullback, the first 5-minute pullback. That's my favorite strategy. That's the one where I made almost all my profits when I took $583 and turned it into 100K. During that challenge, I traded. I guess I'm still trading the challenge, but I'm well over 100K now. But in any case, during that early part of the challenge, I traded reversals a handful of times. The CLVS trade I think was then. The Qualcomm trade was during the challenge. I mean, maybe 6, half a dozen reversals, maybe 12. I mean, really not many. So sure, they add a little icing to the cake, but they're not my primary bread and butter paying the bills strategy. The paying the bills strategy for me is trading momentum. If you are a short bias trader, you can use momentum stocks to trade them to the short side using some of the strategies I'll teach you tomorrow. If you prefer to trade slower moving setups that you have more time to look at, more time to think about, then that's really the value of trading this reversal strategy. We do have some students that are in the class that trade this almost exclusively, but the challenge that they face is scalability, because getting to the point where you can take 3, 4, 5,000 shares of these stocks and make 1,000 a day, you're going to need a really big account to get there. I mean, even for me right now, with over $100,000 in my account, I can't take 5,000 shares of most of these reversal stocks. And if I could, would I really want to put $250,000 into the trade? I mean, I know I'm only risking maybe 10 cents, which is only $500, but what if it got halted pending news? What if something like that happened? Now, all of a sudden, I've got a lot more money tied up into the trade. So I think at the very, very least, understanding the reversal strategy will help you be a better momentum trader, because you'll understand where traders who would take the opposite side will go in for that shift in trend. And then secondly, if you see some low-hanging fruit that's just like a great setup, low risk, sure, you can take it and add a little icing to the cake on that day. All right, so with that said, let's switch gears here and go into the FAQ section of Chapter 7.